right? Either, so a minute, please. Let me quickly send this link so that others can join via YouTube. A minute. Thank you. Hello, can you hear me?
Yeah, we can hear you now.
Yes, sir.
Okay, so I've been speaking to myself since away.
Yes.
Oh, you say, interesting. Okay, Wale, you asked a valid question, right?
Yes. Yes, thank you.
Yeah. In a situation whereby a redeemable debt, please, who is that? The person should meet is Mike. In a situation whereby redeemable debt is just a year, you check the financial year given to you 2023, and you see that it was mentioned in the body that redeemable debt is will be redeemed in 2023 as at the 31st December 2023. That is, it will just be just a year, right? In that case scenario, you will not use internal rate of return because it is just a year. Because what? Because it is just a year. You will not use internal rate of return, right? It is one of the questions we will look at now, whereby the redeemable debt is just a year. If it is just a year, you will not use internal rate of return. Now, one of the questions that Ican test that was tested last diet was that particular question on KPLC. That KPLC, I don't even know. I just saw it somewhere, and I was like, okay, this question is somehow technical because most students may not know how to determine the cost of redeemable debt. Where I can lock the question is from the redeemable debt, or yes, if it's from the is from either the is from the redeemable, I think from the redeemable or loan stock thereabout, right? So what I'm trying to say is that I saw the question somewhere and I say, oh, this question may be tested though, because it's kind of technical somehow. Not that technical, but I just have to. I import the question to be and I actually added it to part of the question. I'm going to I actually solved, I think during intensive class thereabout, right? Or maybe general class. So I don't know that the question we actually came out last diet, right? So it is what it is. It is what it is. So if I give question, so please just go and try it, attempt it. I don't know, me. I don't know. I will just check questions, do my research, and say, okay, let's look at this question, right? So one of the questions we're examining tonight is, I think, one of the past question on KPLC, right? We'll look at this question tonight. We should not forget that the first question here, we only solve for A. We have for B and C. The B part of the question says that discuss how the capital asset pricing model can be used to calculate a project-specific cost of capital for YKPLC, referring to your decision to the key concept of systematic risk, business risk, and a financial risk class. When we get to project-specific cost of capital, if we are moving now to that part, to project-specific cost of capital. When we get to project-specific cost of capital, you will understand the systematic risk. Systematic risk, it is known as unavoidable risk. It is just like unavoidable fixed cost. You cannot avoid it. And if you look at it, it is a systematic risk. You talk about the exchange rate, you talk about the unemployment rate, you talk about the inflation rate, right? These are what? Systematic risk. It cannot be avoided by business, right? We're talking about business risk. We'll explain all these things in details when we get to project-specific cost of capital, but just have the idea. So when you talk about business risk, it's a risk that affects a particular line of a business. A practical illustration is the financial institution, the recapitalization policy. Now, we could see that from last year, which the recapitalization, all banks should meet up with a particular what? A particular capital on or before 31st of March, right? 31st of March 2026, right? Now, look at it. It is a business risk that is affecting the financial institution or the whole bank. They are now in the what? They are now in the capital market. A bank want to do a right issue. The other one want to do bonus issue. You know, everybody is just, the other bank expand internationally because you want to meet up with the capitalization. And you could also see what is actually happening to the market price. So these are the business risks. It is only affecting this line of the business if they make a policy that has to do with okay, let's quickly look at the fuel subsidy, right? Let's quickly look at the fuel subsidy. You know, it actually increased those who are into manufacturing company, it actually increased their production cost, right? Although it also affects some other industry. But if you look at manufacturing sector, these are the people, the company that make use of, most times, those who are not using green energy, they have to use petrol, right? So it is just focusing on a particular sector. So if it affects you, it will not affect others. So what is actually affecting all the online lecture center, right? Maybe is affecting us generally. Any policy, it will also affect others as well, right? We talk about network, for instance. Network is one of the business risk, right? Generally, is that also that's to do with lecture, the financial. So when we get to project specific cost of capital, I will explain in details on this. Now, discuss why the cost of equity is greater than the cost of debt. We have equally explained this in our previous lecture, maybe from the introduction to cost of capital 1 and 2. Class, who can give us why cost of equity is greater than cost of debt? If you know it, unmute your mic. Please unmute your mic so I will move. Hello?
Cost of capital. Hello? Can you hear
I'm
me?
with you. Yes, I can hear you.
Cost of debt has a fixed rate of interest, while cost of capital does not have a
Cost
fixed
of
rate
capital
of
or cost of capital or
cost of debt. Cost of equity does not have a fixed rate of interest, while cost of debt has a fixed rate of interest, like loan stock, like debenture. They have a fixed rate of interest. So cost of equity is riskier than cost of debt.
Okay,
In
that's
addition,
fine. Okay,
we
go
are told
ahead.
that there is a tax relief on a cost of debt. No, unlike cost of equity, there's no tax relief on that.
Okay, is that all? Okay, that's fine. That's a very good one. Do we have any other person that want to add? Discuss why the cost of equity is greater than the cost of debt.
To add that the cost of equity is usually more risky, or is riskier than the cost of debt.
Okay, someone actually mentioned that. There is other parts as well. There's other part as well. During liquidation, who are the people to pay first?
You
Let's
pay
do that.
Debtors, the preferred shareholders, and the debtors.
yes.
Debtors. Okay. That's fine. So we move from there, right? We move. Okay, it is what it is. Excuse me. I think this question is also one of the first questions in KPLC. Which question should we do? This is JP2 is if you check examiner comment on this question, if you look at this question if you look at it that this question is not much. Let me quickly rush it. Oh, it's cost of capital. Let me quickly rush the question. It's not much now. I can do it within 15 minutes. If you check examiner comment on this, it was not good at all, because students failed to understand some concepts here. But we'll do that maybe in our next class. Okay, let's quickly look at this question. Let's solve this question together. This will be our assignment. In KPLC, question 2, please. Question 2 is your assignment. Question 2. So KPLC. So who will read? KPLC. Quickly.
I will read.
Okay, go ahead, please.
KPLC is a listed company that owns and operates a large number
No,
of...
sorry. We actually have we have a principle here, right? We want to solve any question, we have to read the required, because when you understand the required, it is assumed that you solved the 60% of the question. Okay, please, let's pick it up. Let's start from the requirement. Taiwo.
Yeah. Required. A. Using the capital asset pricing model, calculate the required rate of return on equity of KPLC at 30th September 2020. Ignore any impact from the new campsite projects. Briefly explain the implications of a beta of less than 1, such as that for KPLC. B. Calculate the weighted average.
Okay, sorry. So this is just 5 marks. Using the capital asset pricing model, calculate the required rate of return on equity. Can you see? You know, if you remember at the beginning of our lecture on cost of capital, the cost of capital is divided into 2, the equity and debt. Under equity, we have the dividend valuation method, the capital asset pricing model. Then we also have Modigliani and Miller. Now, the capital asset pricing model is another method of estimating cost of equity. This question is even like, I don't know what to say. The question is just too straight that you already know that you have to use capital asset pricing model is a minimum required return, you know, that investors are expecting. So required rate of return on equity. So you should not be confused that which one is a required rate of return on equity. It is capital asset pricing model. It is equity. It is what you are expecting from your investment, right? And briefly explain the implication of less than 1. When a beta is less than 1, there is always an implication to the company. When beta is greater than 1, right, it has implication, right? Because portfolio theory is not in the syllabus, okay? Portfolio theory, okay? I will explain the beta less than 1. Okay, Uzain. Okay, calculate the weighted. Don't worry. Thank you. Calculate the weighted average cost of capital of KPLC, you know, after you've estimate the cost of required rate of return on equity using the capital asset pricing model, you ignore the campsite project. Now, calculate the weighted average cost of capital of KPLC. Use your calculation in answer to requirement A above for the cost of equity. So which means that when you want to determine the weighted average cost of capital, the equity that you calculated in A, you have to use it to calculate the what? In addition, you have to use it to calculate what? The weighted average cost of what? Capital. Ignore any impact from the new campsite project, 10 marks. Whether without further calculations, identify and explain the factors that may change KPLC equity beta during the year ending 30th September 2021. What are the factors that could change the equity that could change the equity beta? 5 marks. Now, we start. KPLC is a listed company. We already know what we want to do, right? KPLC is a listed company that owns and operates a large number of farms throughout the country. A variety of crops are grown, right? Financing structure. The following is an extract from the statement of financial position. We have the ordinary shares, the reserves, irredeemable loan. Class, what are the sources of finance here? What are the sources of finance?
Ordinary shares, irredeemable preference shares, and loan stock.
Thank you. Now, the ordinary shares were quoted at 3 naira per share. 3 naira per share as div on 30th September 2020. Class. This is the ordinary shares were quoted at what? 3 naira per share as div, right? On 30th September 20. So which it means that were quoted. That is the market price or market value as div. That is what is being quoted under the ordinary shares was quoted, right? That is, it was quoted in the what? In the market. That is the market price as div. So you already know that you already have a market price or market value as div. It means that the dividend has been paid. Now, the beta of KPLC equity shares is 0.8. The beta, can you see that the equity beta is 0.8? The annual yield on treasury bill. Another name for treasury bill is what? Another name for treasury bill.
Government.
Another name for treasury bill.
Free risk. I'll be risk-free.
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 Okay. Yes, that's fine. Risk-free or government bond or treasury bill, whichever name they use, right? And financial market experts, an average annual return of 15% on the what? On the market index. Please mute your mic. On the what? On the market index. That is the market what? The market return. And we should not forget that the question says that using the capital asset pricing model. Class, who can remind me that formula? We should not forget that capital asset pricing model is a method of estimating cost of equity. Then what is the formula, class? No, I need to call names.
Risk-free.
Wait, I'm coming. Wait, okay, calm down now. That's you. I'll call him. Olufunmilayo. What is the formula for calculating capital asset pricing model? Are you still with us? I need to confirm. Are you with us? Fumi, are you with us? Okay. Comfort. Are you with us? Well, I'll mute your mic now. They give me thumbs up. What is the formula for calculating the capital asset pricing model? Okay. Damilola, what is the formula for calculating the capital asset pricing model? Okay, let's move on. Mabel.
Okay, the formula of calculating CAPM is that's risk-free rates plus the beta of equity into the market risk market whatever plus minus the risk-free.
Risk market.
That's the premium, yes.
risk markets, whatever.
RF plus beta of equity into multiplied by the premium. That's RM.
No, that is when you are given a premium. In this first paragraph under ordinary shares, under equity, you could see that there is no premium here. So which means that we are using the first formula, which is the risk-free plus equity beta, then into bracket market return minus risk-free. And the risk-free is the treasury bill, right, or government bond, because the assumption is that in the calculation of CAPM, you have risk-free assets. Now, of course, okay, I still have, that's fine. In the calculation of cost of equity using CAPM, there is a risk-free asset. Now, it is an assumption though, because you want to calculate the cost of equity using CAPM, and you should know that cost of equity is actually usually higher than debt, and it is not even risk-free. So, and why adding risk-free into the formula of capital asset pricing model, right, is an assumption. It's one of the assumptions of what CAPM. We'll get there. Now, what I'm trying to explain here is the ordinary shares. For us to determine the cost of equity, we will use CAPM because it is clearly stated in the requirement. But in a situation whereby it is not even stated that you should use the capital asset pricing model to calculate the cost of equity, you should know that ordinary shares, there is no any other, you are not given that there is dividend with growth, right? You're not given any all those information, right? So since you are not given all those information, you should know that yes, you have to use the capital asset pricing model. Now, the market price per preference share was, now you can see that we've moved from ordinary shares. Now you can see for every sources of finance, they will always give you the notes that were attached to it. You can see we started from ordinary shares, right? Ordinary shares. Started from ordinary shares. Now, from ordinary shares to the preference shares, right? From ordinary shares to what? Preference shares. Now, the market price per preference share was 0 naira 90 kobo SDIV on 30th September 2020. You can see that they've already given you information that market price is SDIV. The market price of preference shares is SDIV already, or the market value SDIV is given, right? So it means that the dividend, the preference share dividend has been paid. That is why you have the market price to be what? To be SDIV. Now, watch out, right? Watch out for those who actually do more of research work. Watch out in the NGS, right, group this week. Today is Wednesday, right? Maybe Thursday, Friday. I will check. There are some company that will pay dividend. Now, I will screenshot it and send to the platform that, see, when the dividend is yet, when they declare the dividend, this is the market price. Now, the market price you see as of today in the NGS, right, is the market price. It is cum div, because you are yet to deduct dividend. So immediately they say, oh, their current dividend is this. They will pay a current dividend, they will pay a dividend of 5 naira. Quickly, if you remove the market price minus the dividend, you have the market price as div. Now, that is for the what? That is for the preference shares. Now, to loan stock, class, don't forget, the preference shares market price is not given. Class, who can remind me, what is the formula for calculating the cost of preference shares? The formula for calculating the cost of preference shares. Trust. I trust you. Trust.
That is dividend over market value ex div.
I'm confused. Dividend of market value as div. No, it should not be like that.
Divided by market value ex div.
Now, you can see, yes, you can use, yes, thank you. You can use the current dividend of preference shares, or yes, current dividend of preference shares divided by the market value as div, or the market price as div. Now, class, you can see that the dividend of preference shares was not actually mentioned. The next paragraph, the next line is loan stock interest. They've moved to the next sources of finance. You can see that it is just the preference shares market price. Now, if you recall, now, class, who can tell me what will be the current dividend of preference shares? Who can try? What will be the, no, not who can try now. We did something like this in our previous lecture, right? What is the current dividend of the preference shares? Since it is not mentioned, can you see it wasn't
9%.
mentioned? This is the what? How many percent?
9%.
Thank you. Chop knuckle. Thank you. Can you see? Right? Can you see? It is 9%. Right? It is what? 9%. And you can also show your skill. Right? If you want to show your skill, you can also show your skill that, oh, this is how you arrive at 9%. Fine. Class, am I communicating? Class, are we still together, please?
Show is for
Yes,
me.
That's fine. So we are together. That's fine. So you can see that this cost of capital is very simple. Just analyze the question. Analyze it. Now, the loan stock interest is paid annually in arrears and is allowable for tax at 2020. At 2020, 30%. At 30%, right? That is the tax element. They're giving us the tax rate. Don't forget there will be a relief. They're giving us a tax of 30% that we're applying on the interest. Now, the loan stock was priced at 100 naira 57 kobo as interest. Plus, let's assume that it is not as interest. Now, let's assume that the question now say the loan stock was priced at 100 naira 57 kobo without saying that it is S interest, right? What is that? Is it cum div or S div? If the question say, oh, the loan stock was priced at 100 naira 57 kobo, is it cum div or S div?
Cum interest.
Cum interest. Thank you. Cum interest. That is a very good one. Cum. So you should know that interest has not been deducted. What is the formula? The market price of the debt minus the interest will give you your cum. We give you your S interest, S interest. Now, since it is S interest has been paid, class. Now, nominal, 100 naira nominal on 30th September 2020. Now, class, they keep mentioning 30th September 2020. This is a trap, a very big trap. And this question was examined, was tested last diet. I think maybe question 4 thereabout, right? Or question 5. On 30th September 2020, right? Now, the S interest, the market value S interest is 100 naira 57 kobo. The nominal price, we should not forget, the nominal price is the price being placed on a debt. Or if it is shares, the 1 naira you are seeing there, it is what we call nominal. Now, the loan stock is redeemable. Now, when a loan stock is redeemable, class, what are we going to use to determine the cost of the loan stock? What are we going to use?
IRR.
Thank you. Internal rate of return. Now, there is a problem. There is a challenge here. There will not be problem in Jesus' name. We don't say amen. Okay. Oh. so now there's a little challenge here. The loan stock is redeemable, right? And is redeemable on 30th September 2021. Class, 2021. The question is, what is the financial year of this company? 30th September 2020, which means that I collected a loan from Wale 2020. Then I will pay it back. It has a specific period. I will pay it back in 2021. That is just 1 year. So therefore, you can use internal rate of return to determine the cost because it is just 1 year. If it is 2 years, fine. If it is 3 years, fine. Class, am I communicating, please? Am I communicating, please? Now, we move. Assume that taxation is payable at the end of the year in which taxable profits arise. Now they have a new project. We don't need this, but A new project, because we don't want to move to the project specific cost of capital, right? But then let's read. A new project, difficult trading conditions have caused KPLC to decide to convert a number of its farms into camping sites with effect from the 2021 holiday season. Providing the necessary, now they want to convert their farms into camping sites. Providing the necessary facilities for campers will require major investments, and this will be financed by a new issue of loan stock. Can you see? That is why the loan stock is just, it is redeemable. That is why it is redeemable. Oh, they have to go and source for finance for that particular what? Conversion. That is why they say it will be financed by a new issue of loan stock. The returns on the new campsite business, it is a new campsite business, are likely to have a very, very low correlation with those of the existing farming business. Of course, if it is a new business, you don't expect a new business to just boom like that. No. Next Gen Professional Associates, today we are less than a year, right? Now, we started in 2024, November, right? November 2024, the preparation is just 2 months, right? Now, look at it. As of then, you don't expect magic. Then look at now. So you don't expect that conversion, the new business, the new forms to be, it will be low. Now, class, the question says calculate using the capital asset pricing model. Now, suggested solution. Suggested solution. You can see how we analyze the question. Going forward, we may not be able to analyze it like this because this is just the beginning. We need to understand. Right? Going forward, we just move. Oh, which method are we to use? We use it, then we move, right? But at the beginning, please, we should understand that cost of capital is not difficult. Just understand your formula and when to apply it. Suggested solution. Suggested solution. Suggested solution. What is the name of the company? KPLC. KPLC. Please, this is very important. Always write the name of the company, right? This is 1 mark. It's very important. Okay. Now, A, CAPEM. What is the formula? KE equals to risk-free plus equity beta market return minus a risk-free. We will not use risk premium because risk premium is not given to us in the question. Class, from the question, we are to use the CAPM to determine the cost of equity. Then we will explain when beta is greater than 1 and when it is less than 1. Class, cost of equity equals to what is the risk-free? How many percent is our risk-free in the question? How many percent? 5%. 5. What is the equity beta? What is the equity beta?
8%.
Not
0.8.
0.8. What is the market return given to us in the question?
15%.
What is market return?
15%.
15% minus 5. What is the cost of equity? What is the cost of equity?
Will be 30%.
13.
They play. Okay. 13%, right?
Yes, sir.
Okay.
Yes.
That's fine. Okay. This is one part. And the question says that we have to explain when beta is less than 1. Class, I hope you are with your pen. Right? Your writing material.
Yes, sir.
When beta is... Now, let's quickly go back to the question. Let's quickly go back to the question. What is our beta? Our beta is 0.8. And the question says we should explain the implication of beta less than 1. If you go to NGS today or investing.com or Yahoo Finance, as an investment analyst or a research analyst, you check for
Please,
a
I want to
company.
ask a question.
I'm
Why
coming.
did you okay.
I'm coming. You download a company financials, or you see some financial analysts, they've done the analysis, and you see an equity beta of 0.8. What is the implication? An equity beta of 0.8 indicates that the company's stock is riskless, right? Now, let me put it in another form. When equity beta is greater than 1, let me use that form, right? When equity beta is greater than 1, it indicates that the company stock is risky, right? And some investor who are risk appetite, right? They may want to invest in such company. So when equity beta is greater than 1, it indicates or it shows that the company's stock, KPLC company's stock, is risky. Now, when it is less than 1, it indicates that it is actually what? Riskless. So there is not much risk attached to it. That is the implication. Class, are we still together, please? Are we still together? No.
Yes, sir.
Yes, sir.
Now, having explained this, we move. So, Esther, do you have a question?
Yes.
Okay.
So
Go ahead.
in my mind there, I was thinking 5%, that when we are calculating it, it's supposed to be 5% plus 0.4 multiplied by 7, since 15 minus 5 is 7. So I got 40.6, but I was surprised when they said 13%. So why are we not multiplying by the 7? Because that
Where
bracket,
did you?
I don't know.
15
The bracket open and close, is it not a multiplication sign? Yes, sir.
Esther, save yourself stress.
Okay,
Save
sir.
yourself that stress. Forget about the percentage. Say, if you want to calculate the cost of equity, use the 5 plus 0.8, not percent, so 0.8. Then 15 minus 5 is 10. 10 times 0.8 plus 5 should be 13%.
Okay.
Right? So anytime you are faced with maybe this percentage of a thing, maybe for the conversion. So just save yourself stress of converting 5% or 0. Save yourself, just use 5%. At the end of the day, you will still have the same thing. So you get, so
Okay.
we move.
Thank you.
Thank you. You're welcome. Now,
Mr.
this is
Agi, sorry, I did
a
not get
way.
your explanation. Sorry, I did not get your explanation on the beta when it's better when it's less than 1.
Were you
Sorry,
sleeping then? What are you
no.
doing? Are you sure?
Yes, sir.
Okay. When beta is less than 1, or when beta is greater than 1, it indicates that the company's stock is risky. Greater than 1, risky. Less than 1, riskless, right? That is it. It's opposite. Tere, are we good?
Yes, sir.
Now, this is 5 marks. So calculate the weighted average cost of capital of KPLC at 30th September 2020. Use your calculation in answer to requirement A, above for the cost of equity. Ignore any new impact from the new campsite project. Plus, you should use the cost of equity, which means that you don't need to calculate another cost of equity again. You've already calculated, it is equity and debt. You already calculate the costs of equity already. So you don't need to stress yourself in this B to calculate the cost of equity. That is why they say use the requirement in A. Now, if I want to determine the cost of weighted average cost of capital, plus if I want to determine the weighted average cost of capital, so what are the steps? Weighted average cost of capital. Plus weighted average cost of capital. What are the steps in calculating weighted average cost of capital? Quickly. Are we still together?
1, identify the sources of finance.
Which is ordinary shares, equity, ordinary shares, preference shares, and loan stock. Okay. 1, 2.
Calculate the cost of capital.
Calculate the cost of capital. That is the cost of equity and the cost of debt.
Debt.
Okay. Next step.
Calculate the total market value.
The market value of each.
Thank you.
Total market value.
Calculate the total market value of the cost of capital.
And cost of debt.
The cost of capital, that is the cost of equity and the cost of debt. Then the WACC. Now, if you want to determine that the weighted average cost of capital, our first sources of finance is ordinary shares. And the question I've said that we should use the cost of equity calculated. So we don't need to calculate per pen, right? We just bring the total cost of equity. But if you still want to bring the formula and everything, fine. Now, the cost of equity here is this, right? Now, total market value equals to, I will not write that formula that I wrote in the other time, right? So I will just, let's go back to the question. Total market value. So if I want to determine the total market value for ordinary shares, what and what will I multiply? If I want to determine the total value total market value. What and what should I multiply?
200 million times 3.
200 million. No. How do you arrive at 200 million? Is it 200? Is it 200 million naira times 3?
Times 3 naira. Yes.
I think
200
it's
million
number
naira.
of shares
It's
multiplied that
200 million numbers of share, like units.
Yeah,
Since
because the
the
price
nominal value is
the
1
price
naira,
difference
so
is
it's
1
200
naira.
million units.
Okay. Okay. So don't forget. For first, what is the numbers of shares? 200 million divided by 1 naira is the nominal value. The nominal value could be maybe 50 kobo, 60 kobo. Now is 1 naira. That is 200 million naira divided by 1 naira. That is 200 million shares. Now you have the ordinary shares were quoted 3 naira per share. How many numbers of shares do you have? 200 million shares. And it is 3 naira per share. 3 naira per share times 200 naira will give you the total market value class. Just like the way we did in our previous class. So we move here 200 million. Going forward, I may not be writing this, so just master how we arrive at that now, right? Times 3 naira per share.
600 million.
600 million. So 600 million, we are done with this. The other debts, we are done with ordinary shares. Right? We are done with ordinary shares. The other one is preference. Preference shares. Irredeemable preference shares, right? So our formula for calculating the cost is cost of equity, cost of debt, cost of preference shares, sorry, equals to the preference share dividend. Preference share dividend divided by the market value or market price SD class. Cost of preference shares equals to, what is the preference share dividend class? What is the preference share dividend? You can see that it is not given here, right? But the preference
It's
share
9%.
9%. So we can have
0.09.
Thank you. So do you know why we can convert that 9% to naira, right? We can say, oh, 9 divided by 100 times, what is the nominal value of the preference shares? What is the nominal value of the preference share? 1 naira. Is that not so? 1 naira. So we convert it to, so in case someone, like, sometimes they will want to test your knowledge. You say 9%. How come dividend 9%? Abana. Dividend should be in 3 naira per share, 5 naira per share. This kobo, Now, if you have, for you to get the naira, just say, 9 times 1, 9 naira. Divided by 100, 0.09. Class, are we still together? So we can have 0, you can have 0.09. Right? So 0.09 divided by, what is the market value SD? What is the market value SD? 0.90, right?
Sir, please, where did you get the 1 naira from?
Away.
The nominal value.
If you want to get the naira, is the nominal value. Can you see it? I don't want to, you can use 9%. Like, if you want to explain to someone now, the person will ask you a question that you say 9% dividend. But dividend, I bought shares from Zenith now, then they pay me dividend. The dividend is not in percentage. So how come the dividend will not be in percentage? You now need to like, okay, this is how it works. So it is 9%. So it is 9 divided by 100. What is the nominal value of the shares, of the preference shares? Oh, it is 1 naira. Oh, 9 times 1, that is 9 naira, divided by 100. You have 0 naira, 90 kobo, right? So it is what it is. 9 kobo, right? It is what it is, right? So divided by the market value SDIV. What is the market value SDIV? What is the market value SDIV? 0.90, right? So what is the cost of preference shares?
0.1, 10.
10%.
That's 10. That's 10%. So what will be the total market value? What will be the total market value? So how do we determine the total market value for preference share, class? How do we determine the market value of preference shares?
50 million CS multiplied by 0.9.
0.90.
Okay.
Divided by 1.
Away divided by 1K. Ah. Okay. Okay, that's fine. That's fine. Makes sense. 50 million divided by 1 naira times excuse me, the market value SDIV per share 0.90, right? 0.90 per share. What is the total market value? What is the total market value?
Of 4.5 million.
4.5. What is the next sources of finance, class? What is the next sources of finance? Loan stock.
Loan stock.
And we're told that the loan stock is redeemable. Class, ideally, if it was not mentioned that the loan stock is redeemable, we would not say, okay, loan stock, maybe since it is even loan stock, it is long-term loan, debenture, right? Now, if it is just debenture, we already know that the formula for calculating the cost will be interest open by 1 minus tax rate divided by the market value S interest, right? When it is not redeemable. Now look at it now. The loan stock is redeemable. Now, if you look at it, that we have to use internal rate of return, but you can use internal rate of return when the redeemable period is just a month, a year. Can you see? Please, the person should mute his mic. Who is that? Please mute your mic. Okay. So in a situation like this, you can use internal rate of return because it is just the redeemable period. When you read the redeemable period is just a year, which means that the company borrowed this money for a purpose, and they will return it back in just a year, right? Now, in this case, class, what is the market value? We will not use internal rate of return. What is the market value? S interest.
Sorry, the market value for previous years would be 45, not 4.5.
Exactly.
45 million.
Okay, that's fine. So market value S interest. What is the market value S interest of the loan stock?
100.57.
100 naira 0.57 kobo. What is the nominal value? Don't forget that these are the ingredients we
100
use
naira.
to. These are the ingredients we use to determine the irredeemable, the cost of irredeemable debt. These are the ingredients. You need market value S interest. You need the nominal value, right? If there is premium, in this question, there is no premium. Now, the numbers of years is just 1 year, class. The numbers of years is just what? 1 year. What is the interest? Don't forget, these are the ingredients. Is that not so, class? Class, are we still together?
Yes, sir.
Is this not the ingredients we use to calculate the internal rate of return? Yes, it is, right? Okay. Now, class, what is the interest of the loan stock? What is the interest of the loan stock? What is the
8%.
interest? 8%. Can you see it?
8%.
8%. And there will be a tax relief on the 8%. Is that not so? So if it is 8%, 8%, so we can convert this 8% to naira because we thank you that it will be 8 naira. Thank you. So 8%, 8 divided by 100 times the nominal value. Thank you. Right? You don't need to cram SFM, just understand it. Right? Just understand it. Right? You have 8 naira. That is the interest. And there will be a tax relief on that interest, which means you have to deduct the tax. There will be a tax relief on it, right? Tax relief on interest, right? There will be a tax relief on interest. How many percent is the tax rate? 30%, right? Excuse me. 30 divided by 100 times the 8 naira. What do we have?
5.6.
2.4.
5.6.
Ah,
2.4. 2.4, sir.
2.4.
2.4, 2 naira 4 kobo. So the interest now, when you remove it, you can see that there is a relief. There is a relief. What is when you remove it? What do you have? What is the interest?
5.6.
5.6.
5.6. Ideally, we're supposed to have bring up all these things in our internal rate of return, right? But because the numbers of years for this loan stock is just 1 year and it is redeemable, you can't use internal rate of return for it because it is just 1 year. Now, in this case, how do we determine the cost? How do we determine the cost? Class. The cost of loan stock will be equals to class. This is the interest that you will pay. Should I do it upside down? Oh, okay. It will not work like that. Okay. Now, okay. Now, class, you have to pay interest from 30th, right? From 30th. Should I do it upside down? They work like that. Okay, that's fine. Let me do it like that. It will work. Okay, now, now you have to pay interest for just 1 year, class. And don't forget, if it is the nominal value is the principal, we should not forget that this is the redemption or the principal. You pay interest and principal. Now, class, what is my principal? My principal will be the nominal that you will pay at the end of the 1 year plus the interest. Class, am I communicating? You will pay me my principal, which is the redemption, the nominal, and interest as at the date of maturity. Is that not so? Now, we have picked the nominal and the interest. Now, what about the market value as interest? In this case, you can have the market value divided by the market value as interest. As interest, yeah. Yes, it will work out like this. Divided by the market value as interest minus 1. Minus 1. Yes. Now, let me quickly take you to this. If it is 2 years or 3 years, you have to use internal rate of return, right? Now, quickly, let's say we can't use internal rate of return because it's just for a year. But let's quickly do something. Years, items, cash flow, DCF, then PV. Now, this will be at year 0. The market value as interest. As interest. Oh. As interest. Let's test something, right? To work out like that. So, the interest let's say it is net of tax already, interest. We have it here. Then we have the nominal. We have it here, class. So we can use internal rate of return, but these are the elements, these are the ingredients we need if the loan stock is not redeemable, right? If the loan stock is actually redeemable for like 5 years, if it is for like 5 years, this is what we need, because we need to use internal rate of return to determine the cost. Now you can see that from this formula here, class, you can see that from this formula here, if I have 100, no, let me quickly, sorry. So what is the cost of loan stock here first? Let's get this answer first. I want to do something. I want to test something tonight. So this is 100 plus the tax. There will be a tax relief. We've deducted it, right? The net of it 5.6 divided by market value. Oh, it is 0.57 divided by the market value S interest. Class, what is the cost? What is the cost? Minus
Sir,
1.
So the nominal value is 100 naira, not 100.57.
The market, oh, thank you. Oh, thank you. Thank you. So what do we have? Thank you. What do we have? What is the cost of the loan stock? Why we use this formula is because the loan stock is redeemable within a year. So when it is redeemable within a year, you will not use internal rate of return. But however, you have to use the ingredients that is being used to calculate the internal rate of return to determine the cost of the debt. Class, what do we have here? What do we have?
5%.
Okay, 5%.
5%, right? So here we can have or the market value as interest to be this 5.57. The interest, the net of tax, we've considered the relief. Then we should not forget that this is an outflow. Then the nominal is 100, right? So we cannot actually use this because we need to get the cost, right? So I don't want to do some math. So let's just leave this part. Let's just leave it. Don't worry. Let's just leave it. I'll check. Let's just leave this. But don't forget this formula when the debt is redeemable and it is just for a year. Class, total market value. What is the total market value of the loan stock? Quickly go back to our capital structure. 250, right? Are we still together?
Yes, sir.
Yes.
250. What is the nominal value of the loan stock? What is the nominal value of the loan stock?
100 naira.
100 naira divided by the 100. You can see that this is not 1 naira. It is 100 naira. That is the nominal value of the debt. is 100 naira. It is given in the question. 100 naira. Class, what if the nominal value is not given to you in the question? Because finance generally, sometimes, most times, you can base something based on assumption, but if you can justify your assumption, that's fine. But even in SFM, right, assumption is allowed. Class, in a situation whereby the nominal value, right, the nominal value is not given of a debt, you can assume to be 100. You can assume it to be 100. At the end of that calculation, you now say assumption. During the course of the analysis or from the above calculation, it was assumed that the nominal value of the debt is 100 is allowed. You've stated it. Right? You've stated. So what do we have here? What do we have?
251,425,000.
250 what?
1 million.
54 million.
51, 425.
425. Thank you. So, weighted average cost of capital. We are done with all the sources of finance. Weighted. What is it for? Weighted average. Weighted average cost of capital. Items. Total market value. Cost of capital. When I say cost of capital, it can be equity or debt too. Ash. The first one is ordinary shares. So what is the market value of the ordinary shares, which is CAPM? You know, we use CAPM to calculate the equity. 6 million, right? Are we still together?
Yes, yes, sir, we're
Hello?
together.
Okay. Please, you just give me a figure.
600 million.
million. Coming. The preference shares. Preference shares. What is
Sir, it's 600 million. Sir.
Yes, the ordinary shares.
That is equity, right? Mm-hmm.
Yeah.
So the preference shares is what? 45
million.
The loan stock.
So 251,425,000.
425,000. So what is the cost of capital for ordinary shares? 13%.
Yes, sir.
Yes.
That is 0.13. What is the cost of preference shares?
10%.
10%. That is 0.1. What is the cost of loan stock?
5%.
5%. That is 0.05. So please, someone should add all the total market value. Then please multiply 0.13 times 600 million. What do you have?
78 million.
78. So what do we have here?
For preference share,
450,000.
we have 4.5 million.
4.5 million.
Okay. Next.
$12.571,250
12
million.
571.
571,250.
Okay. So what is the total? What is the total?
896 million.
Which one?
220.
Is it total market value or ash total?
Yes. Total market value.
Is what?
996 million.
Now 100 and
Sorry, 896 million.
896 million.
425,000.
So what do we have here?
95,071.
95071.
250.
250. So what is the formula? WACC is equals to what, class? WACC is equals to?
Ash total divided by total market value.
God bless you. 95, 1, 250. This question is adopted from Ican pass question. You can check. 96, 425. What do you have? I reserve any other question that I need to solve. I reserve it till
We have 10.6%.
10.6% is our weighted market value. The weighted market value, weighted average cost of capital, market value, weighted average cost of capital. Or they can even tell you to calculate Posters weighted average cost of capital, and whichever name it is, weighted average cost of capital. But it is actually different from a book value. I think there's a question that says that we should differentiate between the market value weighted average cost of capital as well as the book value weighted. Yes, this question. Yes, this particular question. Yeah, Jolayemi. All right. So the book value weighted average cost of capital is actually different from the market value weighted average. You can see that this is market value weighted average cost of capital because we consider the market, what is actually happening in the market currently, not the book value, historical. We'll get to that point, right? So distinguished professional colleagues, what do we have again? Okay, the C part of the question. Please, someone should read the C. The C part of this question. Who can read for us, please?
It said, without further calculations, identify and explain the factors that may change KPLC's equity beta during the year ending 30th September 2021.
So, class, what are the things that may actually change the equity beta of KPLC? This is 5 marks. What are the things that will change the equity beta? The question is, what is the equity beta of KPLC? The equity beta of KPLC is 0.8. It means that the company is not, the company stock, it is not actually risky because it is actually less than 1. Is that not so? So what we make the equity beta to increase, it could be because they need to finance a new project. Class. They need to finance a new project. If for instance, Wale have 50,000 naira, 50,000 naira, and Wale want to finance a project that is, let's say, 60,000 naira or 100,000 naira. Wale need to borrow money. So definitely, what Wale have need to change because Wale need to source for this finance. So what I'm trying to explain is that the factor that may allow, that may cause a change in the equity beta. One is the new business venture, right? Is the new business venture. You talk about how the new business venture will be financed. Don't forget that they say the new business venture will be financed by a loan stock. So if the company needs to go and borrow, their equity beta will kind of increase because they have to face some risk. Class, am I communicating? Class, are we still together?
Yes, sir, we're together.
Now, thank you. Now, what I'm trying to explain is that, please, let's understand this particular question. That's, I think it's 5 marks. Now, if I were you, I will look at it that, okay, the company want to finance a new project. And the question is, identify and explain the factor that may change KPLC equity beta during the year. We should not forget that equity beta is a risk that actually what affects the business. Now, and the equity beta of the company is less than 1, which is fair. It's just like you have a gearing ratio, a level of gearing that is less than 50%, right? That is less than 50%. You will say, oh, this is, the company is lowly geared. Now, what will make the company gearing to increase? It could be that they borrow more funds. They borrow more funds to finance a project. And if they borrow more funds to finance a project, the gearing, the level of gearing will change because of that. It could be that the cost of that loan itself may increase the level of gearing. Now, if the equity beta is less than 1, you have to, and they have a new, what will make it to increase? What will make it to change? 1, the new business venture may make the equity beta to change because they may face some risk in opening that what, in converting that their numbers of farm into a what, into a camping site. That is 1. 2 is the new issue of loan stock. It is a debt which will increase their level of gearing. Class, am I communicating, please?
Please come again with that point.
The second one.
You don't say, see, you don't know that all these points, they are just bringing it. Once they bring that point like this, I will just say it. Huh? Okay. So, where did I stop, sir? So,
the level of gearing.
Okay. Now, you have, the question is, what is equity beta? Equity beta measures the risk. A risk that affects a business, right? Systematic risk. Now, if what will make what will make the equity better to change? And I quickly give example of level of gearing, whereby you see that a company level of gearing is below 50%. You see, it is lowly geared. This company is lowly geared. Now, what will make that gearing to increase? It could be that they borrow more funds from the market or from bank loan. Remember that the NPR as of today is 27.4%. Bank will be lending at a basis point, maybe lending at a basis point of 29 to 30%. And the company can go and borrow money from them. So this could actually increase their level of gearing. Now, back to equity. Now, if what we make it to change is the new venture business, because of the risk, they don't know what they will face in that particular business, in that their new project. So that will make the equity better to even increase, because it is less than 1 now. 2 is the new issue of loan stock. The cost of this new issue of loan stock may increase, right? May cause a change in the equity better. Lastly, okay, let us leave it as that too. Thank you so much, everyone. I think I've tried, right? Question. Question. So, assignments, please, I'm too lazy. You can see that I'm too lazy to write, right? You see, I can explain tire, but to write, but that explanation, go and put it down the way you understand it. If I put it down the way I understand it, you too go and put it down the way you will understand it, so that you will remember. That is how it works, right? Class, your assignment, please do question 2. This question is also adopted from ACCA, as well as all other relevant tests. We still have a question 4. I will only solve one question more. After that question, we move to project-specific cost of capital. From project-specific cost of capital, we'll be moving gradually. Hello?
I can hear you, sir.
So we're together, sir.
Okay. So please, your assignment is question 2. Do question 2. Send it to the general platform. Please don't send it to my DM. I beg you. I beg. Please, just send it to the general platform. Right. Send it to the general platform. Then this question 4. I don't know. Maybe in our next class, we'll do the question 4. I think question 4. Yes. Question 4. Should I do it now? Okay. Maybe question 4 or that question 2. Whichever one. Right. So there are some questions that we will not even touch. I have them. I did not actually add those questions to this question bank for a purpose. So in intensive class, because we'll do intensive class, then we'll now solve all those questions. So Lawrence, before we go, Lawrence.
Okay. Good evening. Thank you so much, sir.
Thank you.
Can you hear me?
Yes,
my question is though I've listened to the previous class, I didn't join from the beginning. But in the case when the cum div is given, you may say that in this question that we solve now, the question is talking about X interest, X preference share.
So how do we now convert from cum div, cum interest to the X? Or we can just use the cum to solve the question?
No. You have to convert it. You have to convert it. Have you watched the previous video? Have you done that?
I watched one of the video, but it's hard for me to find because I think you saying some months back the question were uploaded on YouTube. So I don't know.
No. Go and check cost of capital part 1. Check part 2 is there. Check part 1.
Okay.
Yes. Check part 1, part 2.
That same YouTube channel now.
Yes. Check the playlist. Check playlist SFM playlist November 2025.
Oh,
SFM.
I was checking the general platform.
Okay, no. Playlist. Anything that you want to check recently now, for the recent, anything now, even this class now is uploaded, is on YouTube now. If you want to watch it, immediately after the class is there. Just go to the playlist or check live. You will see November, or go to the playlist, you see SFM November 2025. So, and check it is there actually. Do you get?
Okay.
But let me quickly answer your question then, but you can check it so that you have more understanding of it, right? You have to convert it, right? There's a formula for that. But if you have the material as well, so it is equally stated in the material. If you have the material. Don't forget that material is only available for those who have actually paid for it, right?
Okay.
Yeah. Thank you. Any other question, please? Any other question? So we are good, right? Class, are we good?
Yes, sir.
Yes.
Okay. Okay, we are good. Okay. So on this note, I think we have to go. Thank you so much. It's nice doing business with you. So final was right. Final SFM is not difficult. It's not hard at all. You just need to understand the principle, the principles, right? As we move, you will enjoy SFM, honestly. It is not difficult. Understand the principle, understand the rule of the game. You know, what is the rule of the game? The rule of the game is for you to understand the principle, right, and apply appropriate strategy. It is not all about covering all the whole syllabus, all the whole. It is not at all. It is strategy. You see some people that will just read from this part before you know they will pass. So it is not all about reading everything, right? And right, we may finish it. We may actually finish the syllabus, right? And we may not. But guess what? It is what it is at the end of the day, right? So thank you so much, everyone, for joining. For those who actually need the material, so the details will be forwarded to the platform, so you can make your payment, then you get the material. So thank you so much, everyone, for joining. And please do the assignment. Send the suggested solution to the general platform. I will definitely attend to it, right? So feel free to reach out. Just send the message. So just send the message to the platform. I will respond to it. So thank you so much, everyone, and enjoy the rest of your evening. Thank you.
Thank you, sir.
Thank you.
Yeah.